Ever wonder how you can get your investments to pay you almost like a regular paycheck? Well, if you're looking for a way to generate some steady income from the market, you are in exactly the right place. Today, we're jumping headfirst into dividend investing, and we'll be using some real-world examples from companies right here in the Philippines to see how you can make your money work harder for you. Let's get into it.
So here's what we've got on tap. We're going to start with why so many investors are on this quest for stability in the first place. Then we'll crack open the dictionary and decode some key dividend terms so you can speak the language. After that, we'll take a peek at some of the market's high yielders, talk about why the biggest number isn't always the winner, and then we'll wrap it all up with a super practical checklist you can use for your own research.
All right, let's kick things off with Section 1, the quest for stability. You know, for a lot of people, investing isn't just about watching a stock price shoot for the moon. It's about building a reliable, steady source of income.
So let's just think about this for a second. What if you could actually generate cash flow from your portfolio without having to sell your shares? That's the big idea, right? It's the question that really pulls so many investors into the world of dividends.
And the answer to that question is dividend investing. It's actually a pretty simple concept. When a company turns a profit, it can decide to share a slice of that pie with you, the shareholder. You can think of it as a cash reward or a thank you, just for being a part owner of the business.
Okay, so we get the what. Now let's get into the how. In Section 2, we're decoding the lingo. Because to make smart moves, you've got to understand what the numbers are telling you. And these next few metrics are absolutely essential. First up, the big one, dividend yield. This is probably the number you'll hear about most often. It's just a simple percentage that tells you how much cash you're getting back each year compared to the price of the stock. Think of it just like the interest rate on a savings account. The higher the yield, the more income you're getting from that investment.
And just to give you a real test of what this looks like, check this out. According to data from TradingView, SPC Power Corporation has an indicated dividend yield of 11.83%. Now, a number that high, well, that's definitely something that's going to catch an investor's eye.
Next up is the P/E ratio. The easiest way to think about this is like the price tag on a company's earnings. A really high P/E often means the market is expecting big things, lots of growth in the future. A low P/E, on the other hand, might signal a bargain or, and this is important, it could be a warning sign that investors are a little skeptical.
We also have to look at dividend growth. You know, a company that pays a dividend is good, but a company that keeps increasing its dividend year after year, that can be even better. This metric gives you the backstory. Have they been giving their shareholders a raise over time?
And here's what that looks like in the real world. Wow! According to data from investing.com, Panasonic Manufacturing has grown its dividend by more than 37% over the last 5 years. That doesn't just show they're committed to shareholders, it shows a history of giving them a pretty significant pay bump.
All right, now that we've got the lingo down, let's put it to use in Section 3 and meet some of the high yielders. Now, a quick but really important heads up. This is just to illustrate what we've been talking about. This is not, I repeat, not a list of recommendations.
The information you're about to see comes directly from TradingView, and it shows some of the companies on the Philippine Stock Exchange with the highest indicated dividend yields at the time of the data poll.
Okay, let's scan this table together. You see SPC Power right at the top with that huge 11.83% yield and a pretty low PE of 6.83. But then look down at Vistaland. It has a similarly high yield, but wow, its PE ratio is incredibly low at just 1.54. This huge contrast, from Vistaland's super low PE all the way to OceanaGold's much higher 17.59, this is exactly why we can't just stop at that first number.
And that contrast is the perfect lead-in to Section 4, beyond the headline yield. It is so easy to get mesmerized by a big double-digit yield, but the smartest investors know you've got to dig a little deeper.
So, is that high yield the only thing that matters? The short answer is a hard no. In fact, sometimes a super high yield can be a warning sign. Just imagine a company's stock price suddenly tanks because of some bad news. Well, if the dividend payment stays the same, the yield percentage automatically shoots up, making it look really tempting. This is what people call a dividend trap, and it's exactly why we have to look at things like growth and consistency.
This chart tells a really powerful story. On one side, you've got this strong, positive 5-year dividend growth from companies like Panasonic and Rockwell Land. But then you look at the other side and you see Philinvest Land's dividend has actually shrunk over that same period. Understanding this difference is it's crucial.
So here's the bottom line.
A history of growing dividends can be a great sign of a healthy, confident company. But on the flip side, a dividend that's flat or worse, shrinking, could be a red flag that the business is facing some headwinds and might struggle to keep making those payments down the road.
And then there's the whole question of consistency. It really comes down to what you're looking for. Do you want a predictable, once-a-year payment, kind of like what Rockwell Land has done? Or are you okay with a more uneven schedule, which we've seen from companies like Oceana Gold and Panasonic? Look, neither one is better or worse. It just depends on what you need for your own income planning.
And that leads us right into our final section, your research checklist. Let's pull all these threads together and condense everything into a simple, actionable game plan.
Here it is, your 4-step framework. Step 1, check the yield. That's your potential return. Step 2, examine the PE ratio to see how the market feels about it. Step 3, investigate the dividend growth to check its track record. And finally, step 4, note the payout consistency to make sure it actually fits with your financial goals.
All right, let's do a quick flyby of the key takeaways. Dividend investing can be an amazing tool for generating passive income, but you have to look past that flashy headline yield. By digging into the PE ratio, the company's growth history, and its payout consistency, you get a much clearer picture of what you're really looking at. So we'll leave you with this to think about. When you invest, are you planting a tree for the fruit you can get right now, or are you planting one that's going to grow stronger and give you even more fruit for years to come? Answering that question for yourself, well, that's the real first step to building a powerful dividend strategy.